Hello, friends, clients, and fellow financial advisors. My name is Ron Bullis, and I'm the president and CEO of LifeWorks Advisors. I'm really excited to share this conversation with you today with two guys who founded a technology company with a mission and purpose of changing how advisors and clients manage risks in their portfolios. They have a really awesome story to tell and a very powerful vision for how investments should be done in the future. Welcome to the Future of Advice, Alex and Hugo. So Alex, give your name, background, where you're from before we get started.
Sounds good. Thanks for having us, Ron, first of all. Alex Mathé-Cathala. I'm the new Vice President of Investment Strategy at LifeWorks. And I'm a proud Frenchman, so born in France, raised in some part of Western France, small city called Niort, close to Bordeaux for any American person that is familiar with
the wine drinkers here. Yeah.
You may have heard about Bordeaux. So grew up there and then went to capital city, Paris. Background as an undergrad in a variety of subjects, but really an appetite for math and probability and statistics, which brought me to finance. A couple of work experiences in finance, investment banks, investment funds, and then to Boston at MIT for financial engineering masters, where I met this guy.
So lots of math in the background.
Lots of math indeed.
Hugo.
So my name is Hugo Castello. I'm the chief data scientist at LifeWorks, and from France as well, from Normandy, not from the wine region, so it's more of the cheese region, I guess. Background in the US, actually. I've been there for about 7 years, and a lot of data, a lot of finance. That's always been my interest. Met Alex at MIT doing the master program, studying math, finance, and computer science.
We actually met not studying anything.
That's true. Yeah.
We met playing soccer.
Football.
Football. Thank you, Ron.
Yeah.
I remember precisely when that was, because that was when France won the World Cup. So first week of July 2018.
2018, right? Yeah.
Okay.
Yeah, and we met playing soccer, and then we became close friends. Same interest for finance and
football.
And football. Yeah, both supposed to go back to work into to Wall Street, actually, investment management industry. But meeting a professor at MIT changed our career plans, basically.
All right, so both of you guys are from France. I'm not even going to try and pronounce the cities again. I mean, Normandy I can do. Niort.
Perfect. That was
perfect.
Very
All
close.
right, we're getting my French down here as we go. So both of you guys studied, math in France and came to the United States, found each other at MIT, took a class where you were heavily influenced by Professor Robert Merton, correct? Yeah. Why don't you pick up on the story of your company, and we'll talk a little bit about the company that you guys founded, but tell us a little bit more about, either one of you guys, about the catalyst for the idea for your company while you were studying under Professor Merton.
Yep. Can begin that one?
Go for it.
I'll pass on to you, Hugo. The catalyst, very concretely, is one class from that person, Robert C. Merton. Maybe we can expand very quickly on who he is.
Go ahead.
He is probably the brightest mind in the world of finance today, or at least one of the brightest minds of finance in academia. He's a scholar, professor at MIT, economist, mathematician, and is mostly known for having revolutionized the way investors, and institutional investors first, but then individual investors, can think about derivative assets and can price them in a mathematical way. And if it was not for him, it's most likely that option trading today would not exist as it does. And we were actually two students of his class at MIT, and during one of his classes, which was entitled, if I remember correctly, How can you deliver superior performance without increasing Sharpe ratio? In that class, in that very particular class, there was the genesis of the company we were going to create a couple of months later.
Got it. And so I'll stop you right there a second. The really quick description for your company, and the name of it is Aimvest Technologies. Aimvest is a startup born at MIT that's engineered the next generation technology to manage investment risks. Their asset allocation algorithms are designed to help investors achieve their life goals, especially as they go through market downturns. I think that is an amazing statement, especially given the year we just lived through in 2020 and even the start we've had in 2021 with some very interesting market volatility and I won't say disconnected market, but maybe kind of dislocated in some regard. So you guys have a class with Professor Merton entitled How to Deliver Superior Performance.
Right. Yep. And I think even before, getting in the subject and the finance of it, Merton has this sentence that he repeated over and over again, which is best practice is not good enough. And for us, so you can interpret it like many ways, but for us, we directly went to entrepreneurship as a way to apply this in the real world and be able to improve best practice and go beyond what's being done today. Because we thought maybe if we stick to the industry and go work for a big company, we'll just get sucked into it and we'll just make it maybe marginally better.
Incremental changes.
But never by a big leap of improvement.
So say the line again that he said he repeated over and over in his class. Best practices are never...
Best practice is never good enough.
It's never good enough. Okay, so you guys have this class, forms a genesis of your idea. Where do you guys go from there? Do you, huddle up in the dorm room or in your apartment or something and start, scratching some mathematical equations on a paper, or is this like,
That's exactly
beautiful mind kind of thing? Talk to us about,
That's exactly it. So we're still in this space where we're very motivated and excited about founding a company, but at our age, it's still a big risk. So we spend a couple of weeks trying to build some model, test it, get more real about it, and trying to estimate whether we're really down and ready to take the plunge.
Talk to a lot of people. Trying to get assessment of what we were doing, if there was a place for it in the industry, and also just the entrepreneurship community at MIT is really big. So we found tons and tons of people to get feedback on our project, even more than just the finance of it. Because like Alex said, we were 24. 23, 24.
Mm-hmm.
So starting a company and not going to work for a company is...
They would have paid
different.
us.
Yeah, right. And we're actually the only one from our program who started a company that year.
Yeah. And so the validation point, I guess, was after the end of this couple of weeks, basically meeting Merton in person in his office and talking about this project for 2-3 hours, the three of us. Which
we didn't talk much, actually.
Yeah, we didn't talk much. We talked a lot. We listened.
Yeah. So before we maybe jump into what you guys built and the journey that you guys have been on over the last couple of years with founding Aimvest, maybe both of you guys or collectively share what you guys are trying to address or what you see as this big challenge in the industry, right? Both for advisors and clients, and why it's not unique to just advisors or unique to just clients. But why don't you guys share with us the big problem or the challenge that you guys saw a need to find a solution for?
Yeah, so I think it's good that you mentioned it's both for clients and advisors, because the problem we're trying to tackle is really broad, large, and pervasive. And it has to do with the current investment philosophy, and which has been around for half a century at least, which we call a paradigm actually. And this paradigm is the following: that in order to deliver investment services, you need to define a risk tolerance for an individual, and here I'm not only talking about individual investors. You need to define a risk tolerance, which is going to be loosely connected to a volatility target, so a variation in your portfolio as a target. And based on this, you will try to figure out what asset classes and what securities you will put in the portfolio to achieve the best return based on that variation that you will allow. And we think that fundamentally, it's a thought process actually. It's not something very concrete. This is just a broad philosophy, but this broad philosophy have suboptimal results in practice and doesn't do much good to the final investor. Defining all your investment strategy based on the value of funds, the volatility of these funds, and the expected returns of these funds does not fulfill the one most important objective of the client, namely optimizing for the probability of achieving their actual goals and life goals. And that's where we came from, much inspired by Merton.
So what you're describing, I mean, I've been in the wealth management space and doing financial advising for 14 years now. What you just talked about, maybe in a very academic way, I'll try and synthesize it for those of us in my space, is essentially the philosophical approach to investing clients' assets now follows this idea that you take some type of assessment and the client then is scored on how they feel about risk, right? Their portfolio going up or down. And then from that feeling or that assessment of how they perceive risk, that's how we construct a portfolio.
That's exactly it.
Now, I've heard you mention something, or one of you guys mentioned something before, and I can't remember if it was on one of your pitch videos or in one of your white papers, where you talked about how studies have shown that people's feelings change every day, and therefore if they were to truly base their investments off of a feeling about risk or an assessment of how they feel about risk, they'd have to have a different portfolio every day. Is that correct?
Yeah, there's tons of studies showing that the risk score that you get depends on the day you're having, basically.
Yeah.
So if your favorite basketball team won, you're gonna be more risk-taking than if they lost. And on top of that, I would also add that you can take the same risk questionnaire at a different provider and come up with a different answer, which is a big red flag when it comes to having a process that gives you an answer for something quite important.
There are actually many aspects that we really do not like about these risk questionnaires, and I think Ron, you probably share many of these thoughts, and we could expand a lot on.
Yeah, sure, a few more. Yeah, go ahead.
Another aspect that personally makes me very much puzzled or even infuriates me is that you will take a risk questionnaire and you have the feeling that your client will have a customized approach to their risk tolerance, whereas at the end of the day, all those inputs you're going to throw into this questionnaire, at some point, they will be reduced to a single and reductive risk score, a numerical, a number, whether it be from 1 to 5 or 1 to 10 or 1 to 100. At the end of the day, as an individual, you are a number. And this is the exact opposite to what a true customizable process should be. If you have a number, the company that gave you that number, they may have 2,000 clients, out of whom probably 200 would get the same number as you. And it should never be the case that 199 persons have the same risk profile and have the same output as you. And this is, in my opinion, one of the main flaws of this process.
And that number is going to be your number most likely for the next 20 years or something like this. Like it's defined once and it doesn't change unless there is a big event that really push you to retake that risk questionnaire and reassess.
And get the same subjective questions that are going to reduce you to the same reductive number. And yeah, just as you said, Hugo, we shouldn't live in a world where a client in 2021 will know what the composition of their assets is going to be in 2031. That shouldn't be the case. That should really strike people. And that's shock us. And that's why we work on it.
This is something that I've talked about on a few of our other podcasts. I've talked about it on webinars with our current clients and training for advisors. One of my big frustrations with the industry is this very thing, right? When I started out, we used to take people through a 10 or 15 question risk assessment. And then the end of it, it wasn't even as much about a score, it was about labeling them, right? You're a very aggressive investor, an aggressive investor, a conservative, whatever. There's maybe 5 or 6 categories. And then everybody got put into one of those buckets. Yeah. And what I learned over time was that, some people might answer something to the effect of yeah, I'm okay with risk because I'm young. But then when something happened that had an outcome that they weren't expecting, right? Whether it was in the market or in their life or they lost their job, instantly they weren't okay with kind of having everything on the roller coaster, right? Instantly life changed and they're like, maybe I don't like risk, right? And so we started stumbling into this with clients a long time ago, but we didn't have the answer for how to think about investing and managing risk differently, right? So when I started LifeWorks, that was one of the things we set out to try and figure out. And we tried all of the technology, all the modern risk assessments that are out there to give people a number, to try and get more granular with it. And at the end of the day, we found it led back to the same thing, which was we're reducing everybody's unique individual life goals down to a common denominator, and then applying that same denominator to 10, 20, 50,000, whatever the number of people is. And that's how our entire industry, for the most part, the majority of the industry approaches investing.
That's really the result of history when you think about it, because it's a investment product-led industry right now. Mm-hmm. So the goal is to map clients to investment products that already exist. If those products exist, there's a finite set of products that you can choose from, and your questionnaire, the only purpose of it is to bucket, your client to one of those products.
Yep.
And so what we're trying to do is really shift the paradigm and say, you shouldn't map a client to an existing product. You should create a product and come up with a product that's unique for the client and for each client, especially.
And ideally, that product would really fit closely their financial planning goals. And that's where the role of the financial planner, in particular at LifeWorks, is extremely important.
Well, yeah, because then the question becomes, how do you create something unique that's also, suitable for the investor? Because it's easy to do something unique, but you could do something random and it's going to be unique. So that's what we've been working on, I guess.
Yeah, what do they have? The old study about throwing darts at the Wall Street Journal back in the day and landing on stocks and looking at your returns over time and being better than some active money managers. Yeah. Well, so I think you just said something that I think is really, really important there, that we're currently in a state in our industry, and it's probably been this way for a long time, where we are mapping people to an existing investment products. We're kind of taking people's uniqueness and we're shaving off all the uniqueness and trying to funnel it down to you need this target date fund, you need this aggressive portfolio, you need this annuity, right? It's essentially a sales process, right? Taking people and trying to winnow them down and get them close enough as I can to a product, and then saying, this is what you need, take it, right? So back me up a little bit to the class you're sitting in, how to deliver superior returns without increasing the Sharpe ratio. Well, let's do this right now. Alex, define for me what a Sharpe ratio is, just for everybody listening, in case they're not, super familiar with it, just real quick.
I guess the Sharpe ratio is the single most used metric to measure investment performance. And the Sharpe ratio, as its name indicates, is a ratio of the expected return of an asset divided by its expected volatility, or it can be actual return of an asset divided by its actual volatility. So it tells you, for that amount of risk, I have achieved that amount of return. The higher the return you have achieved for a given amount of risk, the more performing your investment manager is deemed.
Yeah.
The lower the return for the same amount of risk, the less performing your investment manager is deemed.
Yeah.
And basically, one of the iron laws of finance, in my opinion, probably you share the same idea, is that delivering superior Sharpe ratios on a consistent, systematic, and trustworthy, by which I mean very well proven basis, is not existent. That's what we always refer to as free lunch. There is no way you're going to deliver superior Sharpe ratios when compared to another investment manager for your clients. And so it's all about trying to rethink your clients' objectives in order to better achieve them and fulfill them.
Got it.
That's where we come from.
Got it. So you guys are sitting in class, right? How to deliver superior results without improving the Sharpe ratio. How do you go from, that class to the idea of risk tolerance questionnaires and how the industry is approaching building portfolios for clients? Was it in that class that this idea came out and you guys were looking at this man, that's a terrible idea, somebody should do something about that? Or was it after that? Tell me a little bit about where that connection to the individual, asset management or wealth management, concept kicked in.
I'm going to take that one because actually it's very interesting. At that point, at least I'll speak for me, probably you'll agree, I really had very little clue as to how individual investors would be advised by financial advisors and what the process would be. And it's only when taking this broad philosophy and going into the details and trying to see what was being done in the industry that we realized the problem was even more acute than we thought it was. And that's how, like, we thought we had a lot of value to add.
So you guys picked the most systemic problem in the industry and said, we're going to take on that one. We're not going to pick an easy one. We're going to take the system that the entire industry kind of bases investments on.
And luckily enough, not only was it true in theory, as Merton would show us, but also it was true in practice. Wherever we would take a look at, we would find these questionnaires, these risk scores, these static allocations based on these static risk scores.
And to be fair, we started from the end a little bit. We started with the solution and not the problem, not being so much aware of, how the risk questionnaire were being used, what were the problems for advisor with them. So we thought of like that, beautiful theoretical solution really as a financial engineers and not as a startuppers, I guess.
Or entrepreneurs, yeah.
Which is, I do not advise to do this for sure. But then we landed on our feet some way, luckily, I guess.
Yep.
Yeah, I mean, I think it's, I might get this wrong, so if I attribute this to the wrong person, I'll correct it later, but there's something about, I think it was Stephen Covey maybe said something like begin with the end in mind or start with the end in mind or something like that. So you guys essentially started with the solution, worked your way back to the application.
Yeah, to find an industry space for it.
Okay, so you guys are at MIT, you have this class, light bulb goes off, you start working on the solution, you guys form a company and you go out there and start talking to advisors and you learn what?
Trying to figure out the product market fit, like what problem is it actually solving?
Yeah.
And that was a little bit of an issue for us to have this solution in search of a problem. And so that's where we started talking, to investors first and not to advisors, because in our mind, we had fairly small knowledge of the advisor space. So we started going to retail investors, trying to understand how they go about investing, what are the problems that they're having right now. And it turns out, the problem that they're having translates into the problem that the advisor is trying to solve. So it generalized pretty well to the advisor space as well.
Yeah, and I think if I consider what we call the Robo advising space, right? The online investment platforms, and there's a lot of them out there, and I think some of them done some amazing things in the industry. But essentially what they're doing, for the most part, for the ones that I've looked at, is a similar kind of risk score, risk assessment. They're taking somebody's age, they're taking maybe their time to retirement, they're walking them through a few questions, and then they're building, essentially an asset allocation that, fits that client, but it's essentially just, a model portfolio handed to that client based off of that assessment, right? So what you guys have started to build, right? And where you guys were coming at this was saying, it's not even about just, having a computerized algorithm to say, here's the 14 ETFs you should own and what percentage, right? You guys are actually talking about creating a custom product for that individual investor's unique goals, correct?
Correct.
Okay, so take us a little bit deeper on that, right? I believe you guys have a name for that system that you built inside of Aimvest, which is called the goal hedging portfolio. Walk us through what that is and why it's different fundamentally and in practice from, a simple kind of algorithm that does a risk assessment, looks at somebody's age and says, here's the 10 investments you should own.
Probably too long of an answer, but we'll try to keep it as short as possible. The general idea is that we wanted to give an individual investor, through their advisor, a process that would help them, given a well-defined investment goal, give them the optimal risk loading that they should have in their portfolio at any point in time. So this is the general idea. Then you must ask the question, well, what is a well-defined goal? How do you think about these things? And that's where really it connects then to the whole paradigm shift that we're trying to implement. We define these goals no longer in terms of volatilities and investment returns, which we think are very obscure and do not tell much to an investor about what they should expect in the future or how is it going to help them do their financial planning. So we move away from this into much more concrete and meaningful and interpretable metrics, which are very concretely a target, a dollar target for a given goal. Let's maybe pick a concrete example. Let's say retirement. Your target, you estimate doing your financial planning with your advisor or financial planning system that LifeWorks has created, you determine $1.5 million into retirement that you need. And we'll call this the target. And then we're going to work around that target to figure out what is going to be the minimum amount that you will need to get from your portfolio, your investment portfolio, at the same time into retirement, just so you don't fall below that amount, because if you did, as was determined by you and your advisor, you would be in a dire situation. You would not be able to basically meet your liabilities into retirement. Mm-hmm. And so this well-defined goal at the end of the day is mostly defined by those two metrics: the target, the floor, obviously the moment in time, so the maturity, and also we connect this to an investment schedule, so size of contributions through time and timing of those contributions. So here we have a set of inputs that are not reduced to a single risk metric, that are not reduced to a single volatility score, but that remain intact through the whole process. And through time, our system, mathematical and computer-based, will tell you what is the optimal risk loading that you must take in order for you to secure this floor and target that amount and hit the target amount, with the highest probability possible. And that's essentially what we've built.
So I'll make sure I say it back to you, because I'm fairly certain that I understand this because we've had some conversations, but for those that are listening and watching. So instead of using a risk assessment, right, and we've beat that up a little bit, and reducing it to a number and then having kind of a static portfolio allocation to that number, right? You guys looked at all of the inputs that were going to be needed and concluded that the shift needs to be figuring out with a high degree of precision what the actual goal should be. Mm-hmm. Now, in 14 years again of doing financial advising, one of the biggest gaps that I've realized is most clients don't have a really good idea. And it's not the client's problem, it's just that there's so many complexities to it. We spend a lot of money on sophisticated, software and financial planning tools to try and get a really good picture of what this number should be, especially a target like retirement, right? Well, I need 1.5 million for retirement if I assume my average rate of return is going to be 8% for the 30 years I'm in retirement. But what if it's 6? Or what if I live for 45 years instead of 30, this kind of thing. So it's a really difficult thing for clients to do. And that's, why they seek out financial advisors, and that's good. So we find the target with as much precision as we can, and then we figure out where the low end of a floor could be. So if our target's here, we can say, look, but we can still make this goal, say retirement, work if we miss the target by 10% or by 15% or something like that. But after that floor, that's when we have to start altering plans potentially, right? Working longer, saving more, something like this. Okay. So then you guys' technology that you build, make sure that we have the least amount of risk that generates the highest possible return that's appropriate for that client, right? So we're not saying, there's zero risk and 20% returns. You say it all the time. There's no such thing as a free lunch, but the maximum upside with the appropriate amount of risk management and downside to get them to their target at the highest probability of success. Yep. Correct?
That's essentially it.
Okay.
The one thing that also in our mind was extremely important in this framework, as you said, the target and the floor are very hard to determine. Mm-hmm. And even if you were in a good position as an advisor to determine this very precisely for your clients, it may be that 5 years after you've chosen the target and the floor, this change. And that's where we've put a lot of attention and effort to make it all very flexible, such that you could, if you wanted, every 3 or 4 days, or even every other day, you could change that floor, that target, and that would have an impact on your portfolio composition at a very minimal cost. That is, we're not trading assets that are going to be costly to exit or enter, and that solution will not force you to stick to a particular allocation during 5 years or 10 years.
Mm-hmm. Yeah, I mean, I think one of the words that you said, flexible, there, I think the democratization of finance, something, that I've talked about on the Future Advice podcast and with our clients, this idea that anyone from just about anywhere in the world with a smartphone can, within a matter of minutes, open an investment account or open a financial account and be trading currencies and options and futures and equities. And by the way, a couple weeks ago, several million of these people all decided to kind of get on the same side of the trade and beat up some hedge funds. Nobody should be crying about that. It's going to go down. I think it's an interesting case study, but the world's going to move and change so rapidly. And I think we're experiencing a period right now, and this is just my opinion, where technology has moved so quickly that the financial markets and how wealth management is done for clients hasn't caught up to it yet, right? We still talk about like rebalancing somebody's portfolio once a year, right? Or adjusting their risk tolerance questionnaire at an annual review. And to me, I just think about the way to win the future as an individual investor and as a financial advisor working with them is that we're going to have to bring solutions that are flexible, right? And that are dynamic. Yeah. Right? Because the world is going to continue moving so quickly that if we can't keep up with that with our investment strategy, right, we're going to get maybe not left behind, but suboptimal results.
Exactly.
Right.
Yep. That's the thoughts we had in mind when building the product. And I say not only does the solution need to be dynamic and flexible, but also it needs to achieve the objectives of the client. Because as we said earlier, you could build anything that you could change the allocation every day, well, it would be flexible. You could build anything that moves randomly according to a market movement, that would be dynamic. But it's another conversation when you have to get those two criteria and still hit your goals. That's where the financial engineering that I think we've successfully built is very valuable in that sense.
And I want to make sure that I'm also clear and that I've heard you guys right on this too. This is not just a computer. This is not just, an algorithm that you guys built, right? I mean, you guys' background is in finance. You have experience in, large investment firms on Wall Street. Talk to me a little bit about the financial expertise, the investment theory and knowledge and research that then goes into the goal hedging portfolio and the system that you guys have built, and why it's not just, a machine, right? I mean, I'll say it because you guys don't need to, right? I see advertisements all the time that talk about artificial intelligence in investment portfolios, and I laugh because I know all it is, they hired some people that have math degrees to write an algorithm to buy and sell ETFs or something. And that seems to me to be missing the point, because to win the future, we have to have an element of high degree of technology, high degree of human touch and expertise that goes in. So talk a little about how your system takes inputs from, let's say you guys or other financial advisors and helps decide what investments should be in there. Talk a little bit about that.
Mm-hmm. Sounds good.
It's definitely, we like to joke about this actually a lot with Alex. With, like you say, all those companies that brand themselves as a smart investment, AI.
Yeah.
We believe there is sophisticated statistical processes, but there is no such thing as a intelligent and self-directed machine that's going to figure out what's best for your financial future. And so the way to think about what we're building is that we are building rules, basically, that are encoded into mathematical formulas. And we apply those rules to ever-changing data, so market data or your goals, and that's going to give us the answer as to what we think is based on those formula, what we think is appropriate for that specific set of inputs. It's not a black box, because it's something that we create. It's something that is highly theoretical. It's not some obscure, system that we cannot read into, and we don't know to explain why your risk increase, why your risk decrease. And because of that, we'll always be able to, trace back to why this decision was made, which we think is very important to give transparency into the decision our model makes. But the domain expertise that we put in is into designing those formulas and designing those rules that are going to take inputs and transform them into an output.
Mm-hmm. Well, and I think this is an important thing to talk about because, there isn't a machine that exists where you can walk up to it like a Willy Wonka, candy machine, right? And just tell it you want this flavor of candy and push a button and out it comes. I mean, there's no such thing as a free lunch. There's no such thing as this artificial intelligence machine that can just maximize returns and minimize risk and doesn't need any, inputs and direction. Right.
Yeah. Well, if there was one, I think their owner would keep it secret.
We wouldn't know about it.
Yeah,
and
sure.
They wouldn't call it artificial intelligence.
Sure. Yeah. Well, that would be the smart thing to do, right? You would just run it for your own behalf and maximize your returns and beat everybody else in the market.
Well, and it's even a philosophical question at that point, but there would be someone behind the creation of this that at some point define the way it's going to make decisions. So, it's like, it's like I say, it's philosophical almost because is the machine really making decisions on themselves? Not in our case at least.
Yeah. So one of the things that we're talking about here to maybe add another definition for those that are listening that wouldn't be familiar is the definition of quantitative analysis or quantitative investing. One of you guys maybe just give us a definition for that, and then I've got a question about how you guys are gonna take that in the GHP, the goal hedging portfolio that you built, and then add things to it like macro analysis and direction around investment strategy. So define first quantitative analysis, quantitative investing for those who are watching that maybe aren't picking up on that as we're talking.
So I would say quantitative analysis or investment or process is anything that follows a well-defined set of rules and therefore that is immune to human biases. So as opposed to some analysts trying to read the news, look at some ratios, talk to the CEO of some companies, and based on that is going to, I don't want to say out of nowhere, but it's going to
have an intuition.
That's a good.
It's intuition versus systematic.
Exactly. So another word for quantitative would be systematic, and I think it's a much better word actually.
Mm-hmm. Agree.
And it goes back to what I said before, that you systematically apply a set of rules to some, then the inputs are just changing, but the rules remain the same. And so that your process is hopefully human bias free, not necessarily because you built it, so you have to be really careful when building it that you do not include human biases in the way that you created. But at least it will be robust in the sense that it will always create the same output for a given set of input, which might not be true for someone following his intuition. That might face the same situation twice, but based on some other factor that, biases, might come up with a different answer.
I think there are a couple of attributes that need to be included in those rules for it to be a true quantitative investing. There has to be some math model at some point. This math model has to be relying on a certain quantity of numerical data, quantitative data as opposed to qualitative, and it has to be treated by some type of computer system. Hence the systematic way of determining an asset allocation.
Yeah, I think the using a systematic approach to investing and even to financial planning, I think is a really, really important thing. One of the biggest biases that I would say I've ran into over time, both with advisors and with clients, is recency bias, right? This idea that, because something's recently happened or because it, happened, over say the last 10 years, that it must be true that it's going to happen again. And I think we see this time and time again. When the markets are hot and running, right? Everybody kind of expects that I shouldn't say everybody, a large percentage of investors might continue to, kind of chase those returns. And then something happens and everybody's like, that was this unforeseen event. And it's like, well, our bias has got in the way. Like maybe when we can remove those and think about having a system that manages risk differently, right? And that approaches planning differently. And
that's interesting that you mentioned like a bias, because quant investing is not, or systematic investing is not, is some magic thing that you apply and works, basically.
Yep.
Because you mentioned a bias, that bias could be very well part of the system that you build. You could have a system that just look back and does something that you would have done, and you'll just make the same error all the time, what you might make the error differently. So it's definitely not like a magic. It gets thrown around like a lot by, you know, like some other firm servicing advisors or even clients, that they have this quantitative process, all of that, and that's great.
It has to be tested.
It has to, like, it's not a magic thing that just works out of the box. It has to be well defined, like everything. I think it's got to be well built.
Yeah. Well, and I think what strikes me as important is using the best parts of, say, you know, a systematic approach to investing with well thought through ideas, say around like macro analysis, right? What's going on in the world around us? What are themes? What are demographics? You know, it's something we talk about at LifeWorks all the time. You know, whether we want to build a better, you know, machine, so to speak, to help us with investing, if we don't think about, you know, the average age of the population and you know, demographics that are baked into the wool, right? That are there's dyed into the wool. Excuse me. We can't change them, and it doesn't matter how good of a, you know, algorithm and you know, system you guys build, right? If we're not conscious of those things.
So it's a very interesting trade-off, actually, because that we can call it like a domain expertise or you know, some knowledge that we bring outside can be the source of biases in your system, but it's also the source to avoid biases in your system. So being aware of certain things can, you know, help you prevent some mistake, but at the same time can make you, you know, you can bring your own mistake in your system.
So another, you know, thing let's talk about it. We don't necessarily need to beat it up, but I'm just curious to get you guys' thoughts on it. It feels like to me, and from observation and talking to a lot of advisors and prospects and clients, that this movement towards, I'll call it static asset allocation strategies. So like target date retirement funds, purely passive investing, right? Just like buy the entire market, hang on for the ride, and that's the most likely way to achieve a successful outcome. It seems to me like that's just an extension of this original problem of kind of risk tolerance questionnaires and risk assessments, right? It's like this idea that, you know, when you're 35, you can pick this target date fund, and, you know, when you're 65, it'll still be the right investment for you because they've just had this glide path, or, you know, this slow shifting of assets. Talk to me a little about some of the other things that maybe are alongside of or a result of the approach that the industry's used with a risk assessment, risk tolerance questionnaires that have now become mainstream products and often advised ways of investing.
Yeah. Now, I think that's definitely still part of this obsolete paradigm that we're trying to dismantle and to disconstruct, in which everything depends on, at the end of the day, one metric, volatility, and the other metric, which is 100% linked to that metric, which is return. And you get an investment that is passive. You know, in 20 years from now, how you're going to be invested, but you don't know how it's going to affect your probabilities of achieving your very personal and unique financial goals in the future. And again, that's always part of the things we want to avoid in order to move into a new realm, almost, where we only focus on your goal, your specific goal. College for your kid in 5 years from now. All right, tell me, how much do you expect to spend? How much will you need at least so you're able not to work more or postpone college for your kid if you don't get there? And then we start with this conclusion. That's where we want to start, with the conclusion, and then figure out the portfolio. All of these things, target date fund, volatility-based portfolio construction, they start with your fear index, your risk tolerance, and then they infer a portfolio that's going to end 10 years, 20 years, 30 years from now with either a success or failure on your goal that we want to avoid.
And target date fund, it's good that you mention it, because it's a very important thing that made us, click, and we really thought when we looked at it, we're like, that, we need to do something better.
Yeah, this is flawed.
So we can look at it like a little more closely, I guess. But the simple idea is the very basic target date fund, whether it's for retirement or any given goal now, is that your allocation in a risky asset is going to decrease as you get closer to the maturity of your investment. So the closer you get to maturity, the less risk. Usually that's a stock versus bond ratio. Applies to retirement, to basically any...
Seems to be the conventional wisdom, right?
Everywhere.
Yeah.
And when you look at it, and so someone who is like 25 right now, or let's say 30 right now, we can tell 20 years from now exactly what portfolio is going to be investing in. So we know exactly, 20 years from now that Alex is going to be invested in 20% bonds and, or like that would be the opposite, more like 20% stock and 80% bonds. But even worse is that me, same age as Alex, I'm going to be in the same situation, exactly the same allocation. So there is really one variable here, it's your age. And it's not a stochastic variable, it's not something that's random, it's something that's, I know in 20 years how old I'm going to be, right? So, so that's a predetermined path that you're going to follow. And that should feel wrong, right? Like you should, when you hear this, I've not met anyone who's like, oh yeah, that's fine, like that's perfect. So every time we mention that, it really triggers something, and it works for us as well.
Yeah, so as you're talking, I just was thinking that instead of having a risk tolerance number, what they're doing is they're reducing everybody down to an age.
So
they're saying everybody at this age should have the same asset allocation, right? Regardless of their life circumstances, their preference, their actual goal.
It's the same as if every year they will give you a new risk questionnaire, and there's only one question, it's how old are you? That would be it.
In order to balance it a little, I think there is one big advantage to this. It's simple. Simple to understand, simple to interpret. And for any unsophisticated client that doesn't want to pay much attention to the composition of their portfolio, it works.
Sure.
And even like another motivation that's probably a big one is that, sure, it's simple to understand, simple to interpret, but it's simple to service.
To deploy and service.
So the investment companies like 30 years ago when they started this, they didn't have fractional shares, they have like high trading cost. So they cannot really do separately managed accounts for the regular person. And so that's what I meant when I'm saying this is a product-led industry. It's historic. Like now we have the technology, we have the fractional shares, we have the low trading cost or zero trading cost to actually build a product that people need.
Well, and this will go back to the beginning of our conversation, right? The quote from Professor Merton, best practices are not good enough.
Yeah, because you could spend years and years trying to improve the incremental return of that target date fund. But at the end of the day, you would do no much good to the end client. Just want to completely remove that legacy or offer an alternative to that legacy.
So one of the things that I'm just wondering if people listening to this are going to have this question is what you guys are describing, what we're seeing now as financial advisors all over the industry kind of described as goal-based investing, right? Conferences that I'm going to virtually, advertisements I get for new technology or from investment funds. This seems to be maybe sitting next to ESG investing, which we'll save that for another conversation. This seems to be something that is kind of a hot ticket item, or I'm seeing it being talked about more and more. How is what you guys are building and what we've been talking about here similar but not the same thing as goal-based investing, or is it the same thing, just more sophisticated?
I think semantics are extremely important, and they define many things in life, and the success of this is only a semantic success, because to us the only thing they've changed is the name. They've moved from so-called risk-based allocations to goal-based allocation, but beneath the surface, it's the exact same thought process and the exact same techniques. So any goal-based investment solution you will find in the market right now will either be tied to your age only or tied to a risk score and will give you a static allocation. Mm-hmm. So not only do we change the name, but we also completely change the allocation process and the techniques underneath the surface. Mm-hmm. And so we move away from this, okay, your goal is retirement, so it's very important. So you must be a conservative investor. So you must have a 60% bond and 40% stock allocation. We move away from this to, okay, your goal is the retirement, but tell me about retirement. How much as a target? How much as a floor? You want to get the highest probability to get your target and you want to secure the floor? Okay, we're here. We're not going to give you a static allocation, but every day from now until the moment you retire, our system will look at your risk loading and update it to still be within this optimization where your floor is secured and you have the highest probability to reach your target. Mm-hmm. Everything is going to move. Everything is path dependent. Nothing is predeterministic, and it's flexible. You can change it. What is the current goal-based investing solution? You want to change your goal while you're going to take a new risk assessment questionnaire.
Well, and I think, I have a 15-year-old daughter who is really phenomenal at math. And as we're talking about math and she's in a debate class, one of the things that came up was the difference between what's possible and what's probable. Mm-hmm. Right? And this is maybe a conversation we've had in our family and with some of the guys in the office, right? One of the flaws that I see with just truly a goals-based approach to investing is it kind of postulates that, sure, this is possible, but it fails to tell somebody how probable it is that they'll actually achieve their outcome.
And it ignores the goal.
And it also does, that's a good point.
If you think of you can make up an example where you take a static allocation and you understand why it's very limited. Like let's say you have 800K to invest today, and 2 years from now you want to buy a house that costs 1 million, right? Mm-hmm. So if in the first year your 800K grows to $1.1 million, let's say, you've already reached enough money to buy the house that you wanted. So you should completely de-risk, right? Mm-hmm. You should just get out of the market, take your cash, keep it for next year, buy the house, or even buy the house right now. If your allocation is static, that's going to ignore this. You're going to be still investing based on a predetermined schedule, and that's a big problem with deterministic allocation. Is that it doesn't take into account everything that will change between the time of now and the time of
It essentially is holding the assumptions static or deterministic, right? It's saying here are the assumptions we're using from point A to point B, and if halfway between the two you've achieved your goal already because the market had a massive run up or something like this, it doesn't change the assumptions that are underlying how those monies invested.
It seems obvious that if your investment goes to 1.1 million. Mm-hmm. After 1 year, or if it stays at 800, mm-hmm. you should do something different. Mm-hmm. And that you cannot tell as of today, you cannot tell what you will need to do in 1 year. You can only tell this after 1 year.
Yep. Got it. And you can only build a systematic model that will help you make the right decision in 1 year based on the data it will have accumulated during the first year. Mm-hmm. That's essentially what
you need your portfolio value after year 1 to be able to make a decision.
Mm-hmm. So how does the system that you guys have built help an advisor and a client, right? Help, say, me and one of my clients understand this difference between what's possible and what's probable, right? Because we want to try and focus on finding the path, if I've been listening to you guys, that has the highest probability of success, correct? Theoretically, anything in this world is possible. Physics aside, there are some things that we can't violate. There are some, absolute truths. But talk to me about how the tool that you guys have been working on, your technological platform, is going to help me, the advisor, work with my client to understand this difference between probability and possibility and how to find solutions that drive the highest probability of success.
Yeah, so definitely we cannot predict the future, so we have to deal with probabilities that very often are hard to grasp or interpret to get a really good feel of what a probability is. But what we can do is define those outcomes and assign, likeliness of those outcomes to happen. That's, the first thing that we do for you is that we tell you there is this probability to reach that outcome. And by doing this, and it's very meaningful to the client, you really define a risk, you define like the risk well, and you get away from something that's
obscure and
that's something that's uncertain.
yeah.
But beyond that, we'll go back to your question. The big difference with what we do and defining those outcomes and really optimizing in that range is that there's like an educational side of it. Is that we'll be able to really guide you and tell you like, look, you want that target. That's very
this
unlikely.
Is preposterous. You should be more.
And you have like kind of that iteration loop that goes on with the advisor and the client that allows you to set reasonable targets.
So maybe to give a concrete example and stick to your 800K, if the client, the only thing they want to invest right now is 800K and they absolutely want to invest them, and they figure out that their goal is to get between 1 million as a floor and 1.5 million as a target in 3 years from now, and they want 100% probability to be within that target, well, immediately what our system will tell the client and the advisor is that there is no way in this world that you have 100% probability to make 800K grow to 1 million at least. And so, as Hugo said, you'll have an iterative feedback loop to tell you, okay, maybe you want to decrease a little your floor to 800K or 750K. Maybe you want to make regular contributions throughout. And here is what the impact from an increase by $50 every month will have on your probability to fall between 1 and 1.1, between 1.1 and 1.2, 1.2 and 1.3, and so forth.
Mm-hmm. And by doing this, you set expectation in a very clear way. Mm-hmm. Your client knows what to expect, and you can easily, at maturity, go back to him and say, look, I've delivered what you expected.
Yeah.
We're within the range. The market did great, so you're in the higher end. We didn't do great, so you're in the lower end. And that's, to us, it's very important to set expectation in a clear way that the client understands. That's how you build trust, really, setting expectation and delivering on them.
Well, and to beat up on my industry a little bit more, our industry now is when things don't go according to plan, right? The firm and or maybe the advisor can go back to the risk tolerance questionnaire and say, well, you told me you wanted to be an aggressive investor and, market dropped 40%, but you picked that, right?
So what does it mean to be aggressive?
Yeah, well, or the reverse, right? Well, you were nervous about the market, so you wanted to be a conservative investor, and so you got X outcome, and the rest of the world got 3X, right? It points the finger back at the client, and what I've
discharge your responsibilities.
Is the client's looking for, us as the professional advisors to bring them really good data so that they can have clarity around the best decision that they can make. It doesn't always mean it'll be the right decision because we can't control the future, we can't predict the future, but there is a way of systematically approaching, financial planning and investing that will increase the probability of success. And giving somebody clarity around look, these small things done really well over time are going to increase the likelihood of you being successful versus not, right? All right, well, let's shift gears just a little bit. This has been really fun so far, but I want to kind of step forward into the future, right? The podcast that we're on is called The Future of Advice, right? And for me, the reason that I started this podcast and wanted to do these interview series was to try and challenge myself as a leader of the firm, the advisors working with us, and then other financial professionals, advisors in the industry that are listening to start thinking about what we need to deliver to our clients and for our clients' benefit 5 years from now, 10 years from now, 20 years from now. And for the clients that are listening and friends, I think this is a really important thing. It might feel like we're speaking to advisors here a second, but you want to be working with an advisor that's thinking about how to build something that's going to win in the future, not how they're going to use what has been done, say, 50 years ago and kind of cling to that. So let's just shift gears a little bit. LifeWorks and Aimvest is merging. We haven't put out the press release yet, but it'll be effective, very shortly here in the next couple of weeks. I have some things that I'd love to talk about here in a minute about why I'm excited about that. But why don't you guys talk a little bit about what you guys are excited to be partnering with LifeWorks around? Yeah. And then I'll maybe share the story after that about how we met, and then we'll wrap the conversation. But take us into the future a little bit. What do you hope the company that you guys built, Aimvest Technologies, partnering with LifeWorks, can deliver for both advisors and clients that gets you really excited, willing to leave your large, wonderful cities and be working out of a sleepy little town in the Midwest called Grand Rapids that's currently covered in, I don't know, maybe 2.5 feet of snow and about 5 degrees outside. Share with us what you're excited about the future and where you see this going.
Yeah, wouldn't have come to an area with so much snow if it wasn't for the great confidence we have in our ability with LifeWorks to really change once and for all this paradigm we've been talking to since the beginning of that interview. Mm-hmm. What I envision would be a new paradigm where advisors would no longer strive to deliver the highest risk-adjusted returns for their clients, which they all try to do and compete for, but rather they would strive to deliver to not only each of their clients, but for each individual goal of each individual client, the optimal outcome distribution for that goal with the optimal probabilities. And that's, in some ways, is the essence of our philosophy and product that we've built. But we really wish, I think, that LifeWorks can be the one force to be reckoned with in that industry, and the one force that has opened this new ocean. Mm-hmm. And I would be personally very proud, and I'm excited about it, if in 10 years from now there is, for example, a new phrase in the financial advisory realm, which is no longer target date fund or no longer, factor investing, but which has to do with goal hedging or optimization for outcome, something like this. I think marketing people will help us figure out a better way to say it. But I would be very proud if LifeWorks is at the beginning of this shift.
Yeah. The idea of linking financial planning and very unique investors' goal to an investment strategy that help them achieve those goals is what excites me the most. Yeah. I think it's a very hard problem to solve. Our solution is a start only to me, and we'll keep building on this.
And I think that one of the main reasons we chose to partner with LifeWorks is that we had our skill set, our philosophy, our math formulas, but we really lacked the hands-on experience, the expertise of the financial advisors that are used to talking to clients, that are used to receiving feedback from the clients, that are used to understanding very well what they like, what they don't like, what they expect, what they don't expect, what they fear, and what they're comfortable with. And bringing math and programmatic models with that very much practical and hands-on experience, and adding to that, you, Ron, as a CEO, your way of being farsighted and your vision, and I like to think ours as well, is, I think, the best platform for us to really make that paradigm shift concrete.
Yeah, I mean, I've been looking for and watching for something like what you guys have built for several years now. Clients and people listening that have heard me share this before, I'll go back to the beginning talking about risk assessments, right? When I was doing risk assessments for clients, risk tolerance questionnaires back when I was a young advisor just starting out, I always thought it was the weirdest thing. I kind of made the analogy if somebody was sick and they went to their doctor and they said, doctor, I'm not feeling well. And the doctor says, well, let's run some tests and figure out what's going on. And the doctor runs some tests and comes back and says, well, I've got bad news for you. You have cancer, right? And the client sitting there is like, whoa, okay. But the world then I was living in was I was literally turning my script pad around as the doctor and then asking them how much chemotherapy and radiation do you want? How do you feel about this? Right? I mean, the logical answer by anybody in that position would be the least amount of poison possible to kill the disease, right? The least amount of risk possible to achieve my goal. And so one of the things that I'm extremely excited about is when we stopped doing risk assessments and risk tolerance questionnaires as a firm a couple of years ago, right? When we really finally said, we can't do this any longer. We don't believe it's in our client's best interest. We entered into the world of building investment portfolios for our clients that were based off their financial plans. And we realized this is tough work, right? This takes a lot of work because the technology didn't exist. And that's what LifeWorks has started to work on building, right? The technology didn't exist to actually connect a client's current financial picture and all of their future goals. We might just kind of lump that together and say their financial plan, right, with their investment strategy. The majority of my colleagues and our colleagues now in the industry, if they were actually honest about it, the investment portfolios they're creating for their clients, the investment solutions they have for their clients are not based off their clients' financial plans. And they don't change and update with the plans in real time or dynamically, right? So what I'm excited about the future is, a year from now, 3 years from now, 5 years from now, as we are putting this together and rolling it out, right? The ability for a client and an advisor in real time to be collaborating on a financial plan, adjust to things going on in the market, going on in the client's life with their job. The client and the advisor work to change their goals and their financial plan, their roadmap, and instantly the appropriate portfolio is created for the client and adjusted to that in real time. Not like 30 days from now or 45 days from now or next quarter or at the end of the year when I rebalance or when I'm a year older because I'm in some kind of target date fund that reduces my investment strategy to my age. So I think what you guys have been building and how you guys started coming at this problem is very, very unique, right? Coming at it as, graduate students at MIT from, I would say, a very theoretical and academic perspective, then going out to Wall Street, talking to advisors and realizing, hey, this is the most pervasive problem for investors and clients in the industry. I mean, I love you guys for this. Like, let's grab our squirt guns and charge hell with a squirt gun, right? Let's go solve the biggest problem, right? And then us at the other end is, I would say, the less theoretical, less academic approach of real world experience, talking to our clients and realizing that the only thing that really matters is managing the risk that a client can't live the life they want. And being frustrated for the last 3-4 years running our firm and trying to figure out how to do this for clients in a dynamic and real way. I think the bringing together of you guys' technological systems and your expertise and the practical experience LifeWorks has and how we're already shifting, I think it will change how clients expect their investments to be managed in the future. And I'm beyond excited about that.
Yeah. So we totally agree. I think the merger was very natural, based on those very obvious synergies, and really hope clients and advisors will see the value and buy into the value proposition.
Yeah, awesome. As we're wrapping up here, any last thoughts for either clients watching this or advisors, maybe your parents and friends? Any last thoughts, shout outs you want to give to something like that as we kind of wrap up?
I think there is this one sentence that you will hear over and over again, but it's never heard enough. There is no free lunch in the world of finance, and any advisor, investment manager that promises something that is close to a free lunch is probably not doing the right thing. And we're trying to move as far away as possible from this. And if you keep this one in mind, I think you're on the right path to build the appropriate investment strategy based on your financial planning.
Yeah, I like that conclusion.
Yeah. Good conclusion. And and I'll wrap it up by repeating the quote that you guys heard from your professor, which is best practices, and I might be messing up a little. Best practices are never good enough.
That was exactly it.
Right. And so friends, family, colleagues, financial advisors, and clients that are watching us, I hope you enjoyed another podcast of The Future of Advice. My name is Ron Bullis. I'm joined by Hugo Castellan, our Chief Data Scientist at LifeWorks Advisors, Alex Mathé-Cathala.
Very well pronounced,
sir. Still getting his last name. Really grateful for the opportunity to sit down and have this conversation with them. I hope that you enjoyed it. If you'd like to learn more about Aimvest Technologies and what the integration of their technology and platform with LifeWorks is all about, you can go to aimvest-technologies.com. aimvest-technologies.com and learn about the goal hedging portfolio, read their white paper. And in the coming weeks here, we'll be having more on lifeworksadvisors.com about the merger and the integration of their platform with LifeWorks. So Awesome conversation. Grateful to get to share it with you. Have a great rest of your day.